Stocks firming up after data's cooled in the ISM services. That's going to give equities a chance to rally, and the small caps maybe need it the most after a failed breakout through 2100. The Russell 2000 continues to be the laggard of the group. Let's get into the sector and talk some picks within the small and mid cap world with Kevin Rendino, CEO at 180 Degree Capital. Welcome back to the show, Kevin.
Good morning. How are you?
Doing pretty well. I want to start with kind of the macro because you've got some good charts that tie the Russell in to the macro backdrop. It seems like the small caps have been the most sensitive to changes in treasuries. Is that what's most important to them, or can they shrug off higher rates like much else of the stock market has?
Well, despite the strong macroeconomic trends, somehow a basket of microcap companies have underperformed the NASDAQ 100 by 4,600 basis points. And this recession, which has been one of the drivers of capital away from risk assets to perceived safer assets, quite frankly, hasn't showed up. And so the underperformance of microcap companies doesn't make any sense to me. You know, we've had persistent predictions of a recession, and yet the GDP rose 3.1%, wages and salaries grew 4.7%, real priced private fixed investment in manufacturing reached all-time highs. So the reality of the economy doesn't match the perceived notion that the world is ending. And so in that regard, the price that you pay for the business that you buy has the highest explanatory power over long-term returns. And the price that you're paying for microcap companies right now is at 25-year lows. So we'd like to set up here going forward.
Okay, so the idea is that with the economy generally holding in firm, I mean, the earnings should, for these companies, also be able to hold in. And what has the limit been? Has it been valuations? Is it, I mean, I've kind of speculated that in today's world, if you want to go on the riskier side of the risk spectrum, why not go into crypto tokens where there's no even perception of cash flow? Like, why would I want to go into the small cap world and take risk when they have to compare to the big caps if I could just go gamble in the crypto world? You think that takes any of the valuation premium out of small caps?
Perhaps. Look, we're activists as well, as you know. We're not just investors. We're collegial and collaborative activists. And so the group of companies that we're covering are unloved, they're underfollowed, they're not represented by the sell side, and they need sort of help to help guide them, you know, create value for their shareholders. So us as activists, we take a different tact when it comes to investing in this group. We don't just buy something and quote unquote hope it works. We go in and collectively work with the management teams and the boards of the companies that we own to try and engineer some sort of 180-degree turn in the business. So not every microcap index or not every microcap stock is created equal. The ones that we tend to own are ones that we get our hands dirty, and we get, you know, we sometimes we join the boards of the companies that we own to try and make sure that we could be a catalyst for change, as opposed to just buying something and hoping it goes up. And then kicking yourself because you didn't own NVIDIA or crypto, as you mentioned.
All right, so it's nice that the backdrop for the economy is firm and solid, but it's not a necessary force for your trades and your investments to work because you're in really kind of in the guts, performing surgery on these companies, trying to get them to turn around. One that stands out to me that's interesting in your list is SCOR. I want to start there with some of the specifics. Speaking of kind of currencies and data and tech connections into like fintech, right?
Yeah. Well, they do. It's sort of competitive media measurement for the media industry, and they have proprietary data. Our original investment thesis centered on their belief that the new investors, Charter, Liberty, and Cerberus, could help improve the execution of the business, and they have. The EBITDA has grown 33% over the last 2 years, and yet at the same time, the stock is down precipitously, and we think that's probably due to some poor corporate governance that's changing. As a result, we've wrapped up our activism. We nominated a gentleman by the name of Matt McLaughlin, who was the former COO of Double Verify, as a director nominee, and the potential for a proxy contest if the management, if the company didn't sort of see Matt's qualifications. The company is going to avoid a proxy contest. They're going to nominate our nominated person, which is great. And now they can focus back on the business. And we think that over time, a company with $50 million of EBITDA, which is what this company has, should trade at a 10 multiple. And that gets you to sort of a $47 stock. The stock's 16 today. So that's the kind of upside that we see for many names in our industry. I mean, that's basically a triple from where we are. And it's not really a pie in the sky valuation. That's just sort of 10 times EBITDA. So that's one that we have a significant ownership in.
Is there growth on the top line? It seems like kind of the margin and the profitability, the cash flow is what you really like about it. Do they have kind of modern media data? Are they able to help a YouTuber, a streaming service, an over-the-top network like us? I still have an association with them as kind of being more tied to legacy media. Does that limit their growth at all?
Yeah, I think that's part of the reason why the stock has declined is everyone views them as a linear television sort of media measurement kind of business. And to some extent, if you look at the top line, it struggled to grow because that's kind of who they are and have been. The reason why we nominated Matt is because he's got digital experience and the growth that ComScore is going to see in its business over the next 2-3 years is going to be finally from all these new digital products that they've developed and now we're bringing to the market in a sort of cross-platform designed way. And yes, the EBITDA growth that we've seen in the last 2 years has been more cost containment and reducing of the operating expenses. The next set of growth for this company in terms of EBITDA growth is going to come from an enhanced top line. And so we think revenue is going to grow faster this year than it did last year and the year before. And then as we look into 25, it's going to grow even faster next year than it did this year in 24 because of their enhanced offerings on the digital side, to your point.
Okay. All right. Case well made. I want to talk about a tech company on the data storage side that you're into that seems like it might be like a takeout target, possibly, strategic alternatives as Synchronos looks to flip to EBITDA or cash flow positive, something profitable?
Yeah, and we just recently joined the board of this company. It's probably our favorite name for 24. They sold their non-core messaging and digital businesses to focus on their cloud-based storage of personal data that they provide the telecommunication companies like an ACNT or Verizon or a SoftBank. It's a deleveraging story. It's an enhanced free cash flow story. They have a material tax refund coming this year, which equates to basically $2.50. The stock's trading at $7.94. Look, companies like this that have top line growth of, let's call it 5 to 10%, 75% gross margins, 25 to 30% free EBITDA margins, and have double-digit free cash flow model, don't trade at 4 times or 5 times EBITDA. And that's where this thing is trading right now. It's had a checkered history, but not under the guided leadership of Jeff Miller and his team. They've done a wonderful job of turning this business around. 24 is going to be the turn where they go from using cash to generating cash that will enable them to pay down some debt. And we think this stock should trade also at 10 times EBITDA, which gets it to a $25 stock, and it's trading at $8 today. As I said, we joined the board. We're going to help the company guide itself towards a better path in terms of telling their story to the street, and we're really excited about this one.
Okay. So next step, what do we look for on the timeline, the calendar, real quick, Kevin, for this company?
Unsynchronous?
Yeah.
We think the stock's going to double this year. It was just at $14 a share about a month ago before the small caps started correcting a little bit here in March, back to $8 for no reason, by the way. They reported the fourth quarter. It was good. They'll report a first quarter, which we also think will be good. They've guided to the year. This is a double in the next few months, we think, as the company reports the first quarter and sets up the balance of the year by telling their story to a broader diverse group of investors than have normally invested in this company before.
Right. We got a high bar set for it for sure. We'll keep an eye on it. It seems like it's basically just pure earnings at this point, watching how the market responds as they get whiff of the new data. Kevin, thanks for the deep dives. Appreciate the insight into what you guys are doing. Fun couple picks there.
You got it. Have a great day.
I appreciate that. Kevin Rendino, another one he likes, ACNT, but that's all we got time for today. CEO at 180 Degree Capital.